Well,
Right.
okay. Well, let me just quickly say hello and thank you to everyone who's already joined or joining. And if anyone comes in late, I'm sure they'll know I said thank you. In saying thank you, I hope, as I'm sure it will be, that you'll find this an interesting and, as always, entertaining panel. I'm not going to steal Clive's thunder. I'll let Clive introduce his panelists and also tell us any ground rules there might be about questions and how he'd like it to operate. If in doubt, use the chat on Zoom to all, and it'll get picked up by one of us, and we'll make sure that the question gets to Clive. But otherwise, have a good hour, and thank you, and over to you, Clive.
Thank you very much. Hello, everybody. Good to see some familiar faces. Haven't seen many of the familiar faces over the last year. We'd love to be in the same room as you, and I'm sure we will at some point soon. Could I ask anybody who's not a panelist to mute themselves, please? Thank you very much. So a couple of things. If you do want to ask a question, please could you, as Paul said, use the chat to all. There is also a sort of a facility for raising your hand, I think, in Zoom as well. But you know, it would be easier if you could do that, and I'll liaise with Paul while we're going on to make sure that flows. We've got a fab panel today, really experienced team. Just very briefly to introduce them to those of you who don't know them: Louis-Jean from STT in South Africa. We've got Pat, CQG, Daniel Curry from Connemara, and Martin Bain from Avenir. You know, there's a lot of ground covered by these companies, and I think what we want to do is to try and understand. You know, things have changed radically in the last year. How much is that change going to stick? How much is it going to affect the status quo? You know, the markets that we've known and loved or hated for however many years we've been in them. You know, this is not going to be the same when we come out of this. You know, the pre-blurb talked about you know, COVID. It talked about office space, but I think, you know, from my perspective, markets are going to be radically different. I think we only need to look at GameStop and Silver recently in terms of what's happened and the influence of new players who haven't had that type of influence before is you know, just simply evidence that you know, we're on changing sands. Anyway, what I'm going to do is, we've got a few topics here. I want to let the conversation flow. So panelists, please, you know, use this as a chance for you guys to have a conversation, quiz each other. You know, obviously I'll prompt. And I think where I'd like to start is just understanding a little bit from each of you is, in the last year, what have you seen as the key changes and the key differences in requirements from the markets that you look after? And Pat, if I could perhaps turn to you to start with that.
Wow. Good morning. Thanks, Clive. I'm really happy to see everybody. It's been a long time. Key differences, there's been so many. I guess the first and most important one is not working in an office with a bunch of people, exchanging ideas, hearing somebody on the phone talking to a customer that, you know, you need to talk to, the difference of working from home. Internally, we did a pretty good job of getting on Microsoft Teams about 2 years ago, or probably a year and a half before the pandemic. And that really helped us kind of transition from that side of things internally. Externally, I think that some of the key changes have been, be it that CQG is you can say we're an independent software vendor, we're a data vendor, we're a lot of different things, been around for 40 years, but we've had to really make some key changes. And some of the key changes here have been, we've gone to a more of a web-based HTML5 product that we call Desktop. Not to sound like an advertisement for CQG, but because we
I'll let
went
you
to
have
that,
that one.
it actually started out as our mobile product, which was to have a mobile product 4 years ago is kind of the in thing, right? We started out with our mobile product, and it ended up being, after we went to HTML5, it worked so well that we went and have it now as our desktop product, which is a new offering. Like I say, web-based, lightweight, easy to put on new things. So it's a widget basically that you would create and then just plug into our desktop. Be it that it's so lightweight and easy to connect to and everything else, it was perfect for the trader that was trading from home, be it institutional or retail. So we made a key change going to that product, unknowing that, as popular as it was going to be because of what happened with the pandemic. Some of those changes.
How much uptake have you seen of the new product? I mean, percentage wise, how many of your clients have moved, or have you moved them? You made them move.
So CQG Trader was our first initial product, and our I guess our product that everyone really knows about is called our integrated client that has our analytics. But our CQG Trader was more of a retail product, and to explain how much the change was, we're sunsetting CQG Trader, and everyone is going on to CQG Desktop. Pretty huge pickup or take up to desktop.
And how much new business have you seen off that?
A lot. Our volume numbers have been the highest they've ever been. We've also decided to going forward. I guess this is kind of public knowledge, but our integrated client, like I said, was our flagship product. We're going to probably end up having a desktop product or HTML5 product that might have 2 or 3 different, like a pro and a gold and a silver or whatever. One's going to have a lot of bells and whistles and the other one won't. So yeah, it's been a huge takeover for us.
And how much of the demand that you're seeing, how much of the change that you're making is driven by, what I would call the traditional trading crowd, and how much of it is driven by the new trading crowd, the crypto or the advancing retail?
Oh, it's definitely the new crowd that's making a big difference. And we are offering cryptos, and we're offering equities that we never did before. We were a futures and options shop, and that's what we knew. Now we're into cryptos. We've always had fixed income, but we basically became a multi-asset platform that we had to change with the times. And this just didn't happen over the last year. I mean, this has been an ongoing thing for probably the last 6-8 years. But the timing couldn't have been better, I guess, to have some of the things that we put in place.
The windfall is always a nice thing to get, right?
Yeah.
So let me park that there with you for the moment. Daniel, let me turn to you. I mean, same question to you. You work closely with the CQG guys. You've got a well-established customer base. What's the biggest takeaway of change that you've seen?
Yeah, well, thanks everyone. Thanks AFM, and it's good to see Pat from CQG. We do a lot of work together.
Yes.
But what we like to say with COVID and the pandemic, from a business standpoint internally, we didn't miss a beat. Pat probably know, like, we're very much just engineers. We're not a lot of business folks here. There's me. I'm in the office. No one's here, even though it's really early right now. But what happened is no one's in the office, but before that, most people weren't in the order. We were very our remote work policy, so we didn't miss a beat, but we certainly feel for the industries that aren't able to operate the way we've been operating for years, but it didn't affect us too much internally. And then externally, we think maybe to Pat's point, like our, and not to tout our product, but our EP3 Exchange platform is the interfaces are HTML5. It's all modern microservices based architecture that we had launched in 2019. And so that's been getting picked up where we're seeing this whole environment is moving so quickly to cloud, to tech enabled for people that have to be remote. So it, in some ways, business has picked up. Other projects that we worked on certainly did slow down, but on balance, it's been good for Connemara. As terrible as that may sound, like we've done well in this environment.
Well, I mean, I think generally for tech firms who were able to adapt quickly, it's been a positive positive environment, you know. And you know, in any of these things, there are winners and there are losers. Who's the greatest demand for change coming from for you?
I guess we touched on blockchain. That's been surging in interest. You know, we noticed a few years ago, certainly it cooled off. There was kind of a land rush and exchanges and matchings were popping up everywhere. A lot, you had to separate the wheat from the chaff. There are so many starting up. Now the market cap for the crypto space has gotten to be significant. There's more institutional interest. So that has become a hot area. We've been doing projects in and around that area, but I would say that's the most growing or interesting area. I know you mentioned GameStop.
Yeah, I mean, we'll talk a bit more about blockchain in a minute, I think, because the whole idea of blockchain, and I do want to explore the have we found the answer before we know the question. Sort of approach to this.
Solution looking for a problem.
Yeah, exactly. Louis-Jean, same question to you. You know, STT, you've got a variety of clients and a variety of products. What's driving the demand for change out of the last year?
Most certainly, one of the big things, Clive, has been our release of cloud-based exchange solutions, and what effect our clients and how our clients approached it. One of the big approaches has been on the risk management and compliance side, where a lot of our clients, especially on the exchange side, derivative side, is taking ownership of the surveillance, conformance, compliance, and the risk management side of the market, sort of offering it as a service to their clients. Which is actually a great way for especially emerging markets to actually grow, where it does alleviate the cost somewhat on the broker firms that's in the market, the exchange offers services like that. And with the advent of cloud-based solutions, of course, it's a lot easier for exchange to perform that function, irrespective of actually where the broker is located. And that's also something we've seen a lot from our clients is a lot of the order flow is not necessarily traditional order flow. It's from various different sources. And of course, there has been quite an uptake on the retail side, playing a bigger role in these markets, which has actually put more emphasis on the risk management side of things. And of course, a lot of the exchanges are now looking at doing pre-order risk management and are currently doing pre-order risk management to make sure their markets are completely risk-free. And with that, we also see different market players now entering, especially on the derivative space. Certain custodians playing a role.
I mean, I think it's an interesting point you make. So what elements of change have you had to make for these new participants? I mean, clearly cloud is something that, you know, that we'll all probably want to talk about in more detail, but you know, what have the new participants wanted from you that the old participants or the traditional participants haven't required?
For a start, they just wanted, I must say, from the new participant point of view, it's simplicity in the data. From a traditional perspective over the last 30 odd years, you know, from exchange perspective, we spew out as much raw data as you can possibly to make sure that the advanced brokers and banks get all the data they need. The new participants don't want that. They want an historical view of the market, but I wanted a simplistic form and comparable with other markets, and actually see where the interaction of those other markets, and actually see how these various contracts and instruments are actually linked up to other instruments around the globe. It's a method from a front end perspective. Our front ends we give out the exchanges is a more simpler front end in terms of what you actually show the end user. Look, and it's been like Pat said, it's been quite easy to do with web-based technologies, simplifying that. You don't need the massive systems to sit at the brokerage to give that kind of data anymore.
Yeah.
Of course, the other side of it is actually what is involved in trading this. A normal brokerage firm would have a clear picture of exactly what the different requirements are climbing into these markets and into these contracts, and exactly know what to do. The new market participants need that information and actually want a short guide to say, listen here, this is how I do it, this is how I approach the instrument, and that's how I trade into it. And of course, what risk am I facing? And that's where the risk management side, it is more not a closed door risk management office like you have in a physical building where you've got two guys sitting behind a closed door doing the risk management. It's not to a picture of actually taking that risk management and then bringing it to user and actually doing more like what if type scenarios to showing this is the effect on your portfolio of doing these trades. And this is based on these market parameters, this is what you're going to sit with at the end of the day.
This is a question I want to come back to all of you in a minute on this, and I'll talk to Martin just presently, but something for you to think about. Do you think that there is a generation of traders who aren't actually aware of what risk really is that we're breeding here?
I'll give you two answers to that question. The answer is in 50 years time, we probably won't see physical humans trading on these exchanges. It will all be algos, and the effect that we will have is what we tell the algos we want at the end of the day, and they will actually interact with the exchange. That's number one. That's let's call that the 50-year vision. That's where we're heading into. That interaction has definitely changed, and of course, from a different perspective, is it's this new generation. Everything needs to be simplistic, easy, and immediately available. There can't be you can't have a 6-month process or a 2-week process even of getting yourself signed up to be able to place an order on the exchange. It needs to happen in the next 10 seconds. Otherwise, you're going to lose the market.
Yeah. All right, let me park that with you there. Martin, I want to come to you. I mean, you've got at Avenir, you've got a massive breadth of markets that you cover, quite a lot in the emerging frontier space. What are the changes that you've seen, and are you seeing any of those sort of frontier markets driving the way that things you think might happen in the future? Can't hear you, Martin. You're on.
Click the right button. Thanks, Clive.
Right.
Sorry about that. Hi everyone.
Thank God you're not in technology.
Yeah, lucky I'm not into that. Yeah. So we're in New Zealand here, so we've been pretty lucky with COVID, hearing all the COVID stories that everyone's got. I won't show off too much, but we've done pretty well. I think just back on your initial question, Clive, I think a lot of what everyone has been saying has been very similar for us. As a tech company, we work from home quite a bit anyway, so it wasn't actually too much of a change for us. I think the international travel conferences like we're having now is probably the biggest loss to us. Our business is a people business at the end of the day. I don't necessarily agree about that. Algos will take over. I think there might be a day of reckoning on that at some point. But I think our business is a people business, and the loss of that has been huge. It's pretty hard to have side conversations about what people are up to when you're in an environment like this. So I think that's probably one of the biggest things that has changed and been hard to adapt to. In terms of our clients, I think we've obviously there's sort of two parts that we do, I guess. We've sort of focused on the post-trade with CCP, CSD, and registry type systems. And then we also have, I guess, another area that looks at warehouse receipts and commodities. on the post-trade stuff, we've certainly seen the volume come through, the retail volume come through. And that's been interesting. I mean, we're fortunate to be a young company and we're sort of built for scale to start. So we've been able to handle that volume. Here in New Zealand, our local exchange hasn't been able to handle that volume. So that has been a real challenge. I think what we've been focusing on, it's interesting, it's sort of similar to what some of the other guys are saying here, is the investors, so the end users wanting more access. So we've been creating more portals for end users to look at things, where in the past a broker or sort of some sort of supervisor might look at or look after all of that, and the investor didn't really care. It was just but as the investors are sort of getting more savvy, they're wanting more and more access to data and understand or their the holdings and post-trade type information that they might not have had in the past. So I think that's one big thing. I think the other thing is, and it was interesting, you guys were just talking about what is risk. I don't think a lot of the sort of retail volume at the moment, the people that are trading that do understand that risk. It's going to be really interesting to see how that plays out. If we have a big correction, will that activity stay or stick, or will it drop off? I think that's going to be a fascinating thing. But we've certainly seen that volume across the board. In Vietnam, the CCP there has doubled the number of trades per day in the last wee while. So there's certainly a lot more activity in the retail guys, for sure. And I think we're just starting to see the sort of seeds of people starting to think, we're coming out of this now. What can we do, and starting up new things, starting to see opportunities. So we're working with some guys to start up a commodity market in South Africa, actually. So so it's sort of quite interesting. I think we're starting to, last year everyone was in hibernation mode, and this year people are just starting to talk about new ideas and new things, and seeing what opportunities might pop out of what's happened over the last year.
I certainly would agree with that. I mean, certainly from my business perspective, the tail end of end of last year was sort of tumbleweed, and the beginning of this year has just gone vertical almost, within days of the year starting, and it's not stopping. And the demand and the interest that's coming in it's almost as if everybody said, well, we'll park last year and we can't do anything, but now everybody suddenly realizes they've got to get on and do something. We've talked, a couple of you, and I apologize, I lost my internet connection in the middle of that, so I missed the beginning of your stuff there, Martin. So I may ask you questions that you've already covered, so apologies if I do. Data, you talked about data, a couple of you talked about data, and one of the problems, and I'm doing some work in this area at the moment, is that exchange data, market data, is all in different formats and different protocols and all sorts of things from every single exchange. How long will users tolerate that? I mean, Pat, I suppose I'll start with you if I can, because you're
Lewis, go ahead if you have something.
So I think everybody on this call, from our software point of view, all of us have some form of fix running in somewhere, and some form of Swift running in somewhere, which you can call as our common denominating factor to make us all equal in the eyes of the broker and end user. But I can tell you, every single of us as well have got a native API which we run, which contains all the, let's call it, the proprietary, very nice stuff that we all have that we want to stick down the line as well. And it's a balancing act. I think I'll correct me if I'm wrong, any of you, but I think from our perspective, it's a balancing act of making sure you always keep up to date with your fixed APIs, making sure they've got all the relevant information everybody needs, but also making sure that your native stuff, which is the stuff we all use for our high frequency trading and our high performance stuff, has got all the necessary stuff in it as well, plus the advantages that we give out to the market. I'll take you back. Every single time Microsoft released a new version of Windows, there is predominantly a new Windows API version that goes with it. And it's basically impossible to keep it consistent across multiple versions. And all of us sit at the same factor. If we build new stuff in, for example, building a new risk management or compliance or blockchain model or cryptocurrency model into our software, inevitably we're going to have to affect our common data flow that we send out. And that's where we sort of diverge. But I think all of us also try and keep our fixed APIs as common and as standard as possible. And the same goes with our Swift API. It's a very, from your perspective, it's very difficult because you get, and I know this from my side as well, because we work with various data vendors as well. You're connecting to 10 different exchanges and there's 10 different ways of receiving the same data.
Yeah.
Which is a problem, but it's not an easily fixed problem. But like I said, we all strive to sort of keep some level of similarity, but it's not always possible. I don't know, Pat, if you want to jump in there on your side.
Well, I agree with everything you're talking about with the APIs. And, you know, we have, I don't know, 4 or 5 different APIs that people can write to, one being our web API, but the fixed API is probably the most popular. And, you know, for CQG, I mean, this is how we started out. Yeah, analytics and data. And because more people are looking to, they have their own front end or they have something they like, but they want to use CQG from a connectivity and data standpoint, it's been a big growing part of our business because we're set up as well as we are with that, with our APIs, that, you know, our business has grown, I hate to say it again, really well because we were set up. I mean, that's who we are. But you're right. When it comes to exchanges, they're all different. And, you know, we write to, I forget what the number is, if it's 62 or 68, it might be 120, but we get data where you can trade on those exchanges, like 68 different ones. And between all the changes that they make throughout the year, I think we have 120 internal, you know, coders and guys that are making the changes that need to do, besides using Connemara to help us because our guys are backed up.
I mean, I suppose one of the things that it sort of leads me to is how much, you know, how much are the participants in the market going, how much longer are they going to tolerate the fact that they've got all of these different protocols, they've got all of these different, you know, 10 different ways of doing it for 10 different exchanges and more. You know, at some point there is going to be, you know, and we've seen it, you know, I've seen it in work I do, and I'm sure you've seen it as well, but, you know, the adoption of something that's new is really, really difficult because everybody on the you know, the market side is full up to the brim with, you know, changes from existing markets. How much, you know, innovation is being stifled. How can we stop that? Martin, you know, it's one for you perhaps.
Yeah, that's $1 million question. How do you stifle that? I mean, yeah, we've been connecting to Fix and Swift connections for a while, and while it might be a standard, it's you know, every market you go to, it's different. And, you know, I don't know what the percentage is, but we allocate, every client we have will allocate time. We just know that there's time. We say we've got a fixed gateway, but it will take X hours or X days to connect to it. I guess being sort of at the end of the chain in that sense, we probably can't drive that so much. It's a really tricky problem. And once you've got legacy type systems in place, and yeah, very hard to move and change those sorts of things. I really, it's not an answer.
No, I mean,
it's a real tricky problem. It's a cost of doing business for us, at least.
Yeah. Yeah. I mean, one of the issues we've seen, you know, we've seen the rise of the innovative, fast fintechs, and yet, you know, the second they're adopted, they become part of the legacy problem. And I don't think we're actually seeing much of a change in the way that a lot of this stuff is adopted. It's brought in and it stops because it goes into that pool of sludge that's called the market, and that pool of sludge doesn't move very, very fast.
I mean, Clive, maybe one point, you know, we've recently, with our UK register, we've just connected to what is the new Ireland CSD, which is actually Euronext in Brussels. And yeah, it's sort of, yeah, it's a real mess. You know, sure, it's called Swift, but the way in which it works and the business logic and the contents of the messages is something, you know, is just different to anything else you've dealt with before. So I don't know whether maybe the answer is that it has to come from the top. I mean, some of these big organizations, the big international CSDs, you know, maybe they need to lead some of the stuff a bit more. And yeah, while there are standards at Swift and Fix for that matter, the way in which these messages are used are just totally different from market to market.
The one thing that's obviously been quite interesting recently, and Daniel, I'll come to you in a second, but I'd be interested in perhaps your view on this, and then we can open it up to the rest of the panel. But we saw at the beginning of the year Brexit finally done, and the European equities volume, cash equities volume from London disappeared in a day. Now, what we see there is the use of technology to automatically flow elsewhere. Technology has, once again, particularly in equity markets, shown that it is able to facilitate movement of flow. So BATS, Chi-X did it in the first place, and now we've seen it again. How much can that influence the derivatives markets? Because we've got long tail open interest. How do we, how does technology enable challenges within the derivatives space?
Yeah, that's interesting. Just to rewind to the last question, though, I'd say one comment about FIX and these other protocols. It's been an endless stream of work, so I hope it doesn't get solved for Connemara dealing with these. Just kidding. But yeah, from our perspective, your question about enabling we are always involved in projects where, if it's a multi-asset project and newer technologies, whether it's equities, I don't know if our view on it as technology enabler or on projects will certainly help facilitate that, but we might not have the right perspective for us where the industry is taking us on that.
Yeah, I mean, I don't know, Martin or Pat or Louis-Jean, have you got any views on the sort of the technology driving the development of new products within the derivative space, or the support for competition within the derivative space? Because I think it's been one of the big problems, is that the open interest is sticky, and I can't believe that there isn't some form of opportunity within the technology stack to actually start moving that.
You would think, but I'll tell you what, the exchanges make it more and more difficult. Nothing against anyone here on the exchange, but the cost that these exchanges are starting to charge are crushing some of the opportunities. Some of these younger technology companies coming in, they can't afford it. Even from a trading standpoint, some of the traders can't afford it. It seems like constantly there's more and more exchanges asking for more and more money. Now, some of the newer exchanges that have come about, for example, maybe the small exchange, which is, a lot of the Europeans might not have heard of it, but micro products, right? Small, just with the micro products that came out from the CME, the small exchange is just that, trading micro products. And they're also not charging for data. It's going down to smaller tick sizes so people can afford it. I think it all surrounds around money, to be honest with you, when it comes down to it, Clive. I mean, that's kind of an obvious one. I'm sure somebody else has a better answer to it, but
I mean, it's difficult, because are we getting to the stage in, the Standard Oil type model where the regulators look at breaking the exchanges up?
Yeah.
I mean, are we getting to the point where the control of the monopoly is just in too few hands, and the regulators decide they have to break it up? It's happening in big tech. Why wouldn't it happen in exchanges?
I think you're right about the regulators influencing this. The markets that we're involved in, I don't think it's sort of the too big to fail type problem that they're worried about with exchanges or the monopoly power. I think it's more the regulators just layering on this, what they think is sort of risk mitigation, which only, with a view to benefiting the small guys, but actually all this risk mitigation that they layer on top of the exchanges just adds cost, and the little guys miss out, and it just becomes harder for them to enter. I think that's perhaps the bigger problem.
One thing that we've seen is especially on the equity and bond markets, is smaller competitive exchanges that focuses on a niche set of products coming out and tackling that market from a different perspective, trying to sort of lower the cost of entry, but also sort of expand the field to a certain extent of who's got accessibility to those contracts as well. And I think in derivatives, the same thing will happen. It's just it's a method of the market growing into and somebody taking up the opportunity and actually then an exchange moving on with it and taking it where it's not before. We see it on the equities market, but we do not see it a lot on the derivative space yet. But I'm pretty sure it's coming.
Yeah, and I also think that you're seeing a cyclical comeback of the retail markets. I mean, more than ever now, with call it the pandemic and everything else, but the retail, even some of the bigger exchanges like the CME are going towards the retail. They're all directed towards retail now. And
Yeah.
I don't know if you're seeing that trend in Europe and elsewhere.
Oh, yeah,
Asia obviously
absolutely.
is more retail oriented, and you're starting to see a pickup there. But I think that part of it, Lujan, I think it's being directed towards the retail customer.
I mean, the regulatory framework within Europe is more difficult for the retail customer is more protected, and therefore perhaps less of an influence, I think, we've seen in Europe than perhaps Asia or US. It's there, but I don't think it's as high. I suppose the issue here is, at what point does the regulator start changing their view on how they look at retail, because retail is starting to be a fundamental in the market, rather than it just being noise.
You picking up on Pat talking about Asia and the retail side. I mean, one thing we see is, or seen at Vietnam at least, is that their accounts are all segregated. So at the exchange level, they manage risk at a per client level, so the broker doesn't actually do that. So that's certainly one way to, I guess, give comfort to the regulators, that they don't have a whole lot of investors in one or more risky brokers. So perhaps perhaps the risk is more for the brokers being disintermediated by this new process and losing out on some of those netting efficiencies that they might otherwise get with margining. But I don't know whether that's extending all the way into Europe, but certainly in Asia, the client level segregation of accounts is happening at the CCPs.
Yeah, I mean, the only other one I know that does that is Brazil, is B3. But I mean, I think it's probably the way that that things are going. Let's just sort of move slightly on a tangent. I want to talk a bit about surveillance. And I mean, we spend our lives on video, and I don't see much in terms of video surveillance being available to the marketplace, i.e. surveillance of people's activities on a video call. Yes, you can record a video, but you're not getting real time. Is anybody seeing anything moving there?
A really good one you can't see, Clive. Surveillance. It's the key.
Yeah.
Just kidding.
Well, problem is it's not there if you can't see it.
Yeah, that's right.
From a surveillance point of view, what we're seeing and what we do, and it's a lot of our competitors do, is actually at big banks on trading floors, and we've been doing it for years now. Is you take actually the telephone feed and the video feed on the trading floor and actually use that in conjunction with the trades they've booked. So when the compliance officer actually looks at certain market alerts or events that occurred, wash trades, short selling, that kind of stuff, can actually view when the trade occurred with the accompanying call plus the video feed of what actually happened at his desk.
Yeah.
That is in existence. The surveillance departments run on it. The movement that we're seeing on the surveillance sphere is more about the AI side, the machine learning side of actually taking all the data, taking necessary market events and emails and stuff, and actually having a look and see what is actually insider trading and the front running type alerts that's happening in those markets. That's actually currently where a lot of the surveillance effort is going into, is the more intelligent type of surveillance than the more, well, somebody booked the trade more than what the average is, so let's slap them with a fine.
Yeah. And there's quite a few companies in the States that have come up. I can't think of one of their names right now, but that are making a real business out of their surveillance. And that's what they're doing. That's what they're looking for. They're looking for the front runners. They're looking for
Eventus is a good example.
Yeah, Eventus. Thank you. That's the one I was trying to think of, because that's the ones I know. But they're trying to look for those inconsistencies and everything else. I mean, you look at 40 years ago, when I started in 1980 on the floor and you're handing in your trading cards to a clerk, and, you're using a pencil and you're erasing. I mean, the audit trails today are, kind of head and tails.
Yeah.
Yeah, we're used to sending all the surveillance from the exchange to Aventus, for example, and NFA, but I haven't had video come up yet. So I want to see bring that up if they haven't been sending.
Yeah, I mean, it just seems to me that, if we're sitting on a call and I'm saying one thing, but I'm holding up a card that says, when I say buy, I mean sell.
Yeah.
How's that captured?
Well, you got your shot, right? So now the video is working for you. Just kidding.
You would be a modern Clive. You'd be a modern banks trading floor is probably one of the most surveilled things. There's not a webcam or a CCTV camera that doesn't capture anything these days.
Yeah, but these people are, a lot of them are working from home, and I don't expect that that's going to change a great deal. I mean, yes, Goldman came out and said, this is an aberration, and we're going to go back to the office.
Moving to Florida.
I mean, HSBC are ditching 40% of their office space. So,
but and I think the net effect of that is that is quite something, because a lot of the banks' massive trading floors with 300 guys sitting in a row trading, all of a sudden having to work from home. And how does your surveillance software work then? And then with the more retail flow coming into this market, and that's where we're seeing the change happening. So there's a lot more restrictions and regulation placed on the individual traders booking these trades and trying to get the flow more into the retail space and actually starting surveilling that. Because exactly like you say, how do you monitor a guy sitting at home holding up a placard to say my buys are equal to sells? And that is a real problem. And I think it's a common problem, and all the banks are currently struggling with that exact same thing.
Yeah, I think, Clive, I think it's right. I think the retail flow. I mean, you talked about 300,000 traders. There might be at brokers. There might be 3 million or 30 million people trading on Robinhood, all looking at Reddit and Twitter and all this sort of stuff. I think the fascinating thing for me is what is you can have a manufactured insider. So you've got someone who's tweeting something that says it's about a company earnings, but it's not. And it's sort of manufactured inside information that people can ride on. I think that to me, that's absolutely fascinating. I really don't know where that's going to end. And I think someone just said, the brokers are perhaps over, they've maxed out on their regulation at the moment. I don't know if you can put them in more of a straitjacket than they already are.
It makes the view of the commitment of traders report and the retail positions on that a very different, a very different view, doesn't it? We've not talked about AI and machine learning, and I think it's important for us to talk a bit about that. These are buzz phrases at the moment. Where do you see us going in the nearish future with this? Because I don't think it's easy to take the crystal ball, but where do you see those two, AI and machine learning playing a role within the markets that the technology that you're responsible for looking after? Daniel, perhaps start with you.
Yeah, that's interesting. We our clients that'll be connecting are using those sort of technologies to send orders. Maybe to Lewis's comment earlier, maybe everything will be AI driven eventually. And with microservices architecture, it's easy to modify or take a piece of instead of it being a monolithic architecture. So I think these things will start getting more closer to the exchange platform level, which we're normally operating at. But it's probably the way it'll go, but we're not seeing much of it yet.
I mean, are we at the stage now where I don't suspect we are, but it sort of seems like we might get there, where you've got algorithms arbing algorithms?
Yeah, like a bot versus bot.
Yeah,
I think that's happening.
I mean, if we get to the point where the markets are almost entirely, algorithmically driven, then surely that's the end conclusion. Itself, it will just be bot-driven markets, volatility on the basis of algorithms. And I'm not
I disagree.
I'm not sure that's healthy.
I think that the analogy of you find a racetrack, be an exchange or an exchange versus an exchange if you're doing spreading, you can have a great race car. That could be your algo. But I still think you have to have a driver, and there's always going to be that human element that you still have to have involved. It can't be an algo on an algo. You still have to, you could have the fastest car on that track, but you still, it's going to be the driver, you know, or that human intervention, whatever you want to say, that makes you a winner.
You see, I don't
No?
know whether I'm not sure I agree with that long term.
Okay, well, I tried. It was a good analogy.
I think
Sticking up
it's
for
it's a fair
humans.
point, and I think, you know, from everything that I do, I expect there to see people looking after this. But at some point, when, you know, if the technology is built well enough, surely the people become redundant in that. I don't think that's too far off.
See, it's going to happen undoubtedly, but I don't think it's in the next couple of 2-3 years.
I hope.
But,
I
but
hope
then
not.
again, you never know what happens from year to year. So.
But Clive,
After 2020, especially.
Yeah.
100 years ago, a huge industry was people walking down the streets, putting out and switching on street lamps, you know?
That's just when I started.
You know, but Pat is correct. It's like humans feeding into the system and the system trading by itself. You feed your data in. The driver is still the expectation, the human that sets basically the scenario, and the algos are just executing the scenarios based on the best method in profit and loss they can probably get. I can't see you really getting away from algos doing algos. Checking weather patterns, having a look at soil samples to trade commodity products. You know, you're going to still have some level of human element in there, but the order flow will probably be completely electronic. You won't have a human anywhere close to it. That's probably where we're heading into. And we're not far from that at the moment, to be honest with you. How many exchanges are basically sitting with 80% the order flow from algos? You know?
Yeah, quite a few. Yeah. We haven't talked about clearing much, and I think it's important that we allow that. We allow clearing some time. I'm aware we've only got 10 minutes, and we've not had any questions from the audience. Please do, if you have questions, please do just pop them in the chat. I'll keep an eye on that. Where is technology making a difference in the clearing space? Martin, do you want to kick off?
I think where I probably mentioned this a wee bit earlier about the pre-trade. Well, not so much pre-trade, but we call it pre-margining with VSD. So we're sort of real time when a trade comes in, we check that against the collateral. So rather than having end of day margin calls and checking against collateral and sort of balancing the books at the end of the day, we're doing that intraday. And if a trade comes through that might breach a collateral limit, we send a message back to the trading system to warn them, obviously not to stop the system because he may want to trade again to correct the position, but warnings back to the trading system. So I think more of that real time, real time. So not only just clearing the trade, but actually checking against collateral real time is certainly coming a lot more. You can certainly see it in the OTC markets. It's starting to happen a lot more rather than that end of day batch driven process.
Yeah. Anybody else got any thoughts?
No reason to stop. Sorry, you go.
No. I think, yeah. Sorry, I was wondering if anybody else had any other thoughts on clearing, because one of the things that occurs to me is that blockchain's all lovely until such time as you realise it's 100% paid up on the spot.
Yeah,
which makes it a cash market.
Exactly like Martin says, we're doing exactly. It's pre-order risk. You do that, and we're seeing a lot of cash equity markets doing immediate settlement now. At the moment, you know, you pre-check cash and script, and on trade you do immediate settlement. And we see that, and it's going to be a matter of time before that occurs on derivatives markets as well. To be honest with you, exactly like Martin said, the risk management enables immediate settlement. You know, cash flow immediately. That is going to definitely happen. In terms of blockchain, never forget there's a thing at the back of a blockchain. And if you want to see this on Bitcoin, you can go and Google orphan nodes. and you can see how many millions of Bitcoins are orphan nodes sitting on the blockchain. That will scare you, most certainly. But what we're seeing is a lot of clients are looking at using the blockchain for, of course, for settlement and using private blockchains to actually implement it. I don't know if anybody else has a comment on that. We have a lot of clients that's deeply looking into it and facing those problems, trying to resolve it with business solutions.
Yeah, I mean, it's difficult. How are they approaching that then?
It's sort of like replacing the CCP, not the CCP, sort of the clearing function or the equities custodial function with a blockchain, to be honest with you. Taking the CSD away and replacing it basically with a blockchain. But it's easier said than done, to be honest with you. There is a lot of risk involved in that as well. And of course, you'll see a lot of custodians on the planet is actually now looking and saying, well, if blockchain takes off, there's a huge risk to our business. And we see a lot of them actually embracing and trying to fit in solutions to actually utilize blockchains to actually, not in terms of making more money, but in terms of saving their business in the future. Because if from a paper-based perspective, if you see it on paper, you can use it to replace the CSD. But is it a viable replacement of the CSD?
Well, I suppose if it's a fully paid up security, then T+2 or T instantaneous is two versions of the same thing. If you're talking about a leverage product, that's a very different product, isn't it?
Yes, and if you, let's say you book a derivative, or if you take it from a spot perspective, pretty simple, you interact with blockchain, you make the transaction, the ledger is right there. You take that to a derivative market, and how do you implement that derivative? And if you have a derivative on top of that equity, like a single stock future, for example, how would you implement that? And what is the net effect of it? When do you do that interaction? How would physical settlement works? And I think, Clive, that is a fantastic question for the audience, mate.
Well, from our
let's open it up.
We see, Clive, from our perspective, we see blockchain as, I think I said this last year at the conference, it's just another database from our perspective.
Yeah.
And I don't think it's the right sort of database for a lot of what we're doing. It sort of adds sort of complexity, and a lot of the edge cases are really problematic. Thinking of our retail registry products, you have an investor who dies and their keys are lost. I mean, how do you get their shares out of the blockchain? You don't. They're lost. It's just sort of some of those practical interfaces with the real world don't work. I think it's got its uses, and it makes sense for some purposes. But just need to be really careful about where it interfaces with the real world and where you might have fraud, or just putting it on blockchain doesn't mean it's safe and secure. And there's
again, I think as I said earlier, I think we get to the answer before the question problem.
Absolutely.
Daniel, what do you from your perspective? I don't know how much you get involved with the blockchain side of things. What are you seeing as the drivers in that space?
That is tying it to clearing. It's the one use case that we discuss here that does seem to make sense. And we even have a client, I think when we first joined AFM, was Richard Sandor's AFX Exchange, American Financial Exchange. So he has us publishing his transaction details to a blockchain. It's a project we did. So it is an interesting use case. And then just speaking to this in general, as I think I was mentioning earlier, a lot of the interest in blockchain, being institutional now, our role is often to come in and a lot of the early participants weren't using modern capital markets technology. So there seems to be a lot of work there, a lot of interest there. That's maybe broader to your question. But
look, we've got 4 minutes left of our time. It seems to have gone remarkably quickly. Could you, perhaps I'm going to ask you to use the crystal ball and just give us a quick view, I think, in the absence of any questions from the audience, of where you think the real bombs in technology will be. What's going to really make a difference? What's going to change things?
Well, we're seeing more, if you go, we haven't talked about the ag markets, the agricultural markets, but we've now gone a direction for CQG that maybe that's what we started out. Now we're going back to it. The commercial grain industry and trying to get the elevators and the farmers to start doing things electronically and hedge their positions. And we're going down that line. We've just spent like the last 3 years or so doing a lot of work, and it seems like kind of it's a frontier that hasn't been that touched very much yet. And so we're going down that line. Is it the right line to go down? I don't know. The other thing is, Asia and China. We've opened up an office there and have put a lot of time and effort to get that up and going, thinking that that's going to be the next area, where we should be. We hope that that's the case. But then again, to be a little condescending to not always doing the right things. I mean, we just wrote the B3. I mean, B3's been around for a while, but we used to access it through the CME when it was the BMF Bovespa. But so those are some of the things that I think looking forward that can make a difference.
Yeah. Now we had a hand up.
It's me.
Yes, hello.
Good afternoon, gentlemen. It's nice to hear to see all of you. Thank you very much for the discussion. I have maybe a strange question. It's about crypto world, but not about blockchain. Now we see, let's look at crypto exchanges, but let's look at them not from the angle of what they're trading, but from the angle of how they're trading. And at this point, how they're clearing. They are not CCPs, neither legally nor actually, but they do perform some clearing function. And probably they do it more or less successfully at the cost of high risk of mutualization of losses with good guys. So my question is, couldn't this simplified model of risk management, could this model be applied at fiat exchanges? At fiat clearing houses, to be more precise.
Okay. Who'd like to?
The answer I would say is yes, most certainly. The stumbling block here is understanding central banks and regulators to actually accept it and allow that to run forward like that. But and like Clive's question about what do we see in the future, that is with the advent of exchanges sitting in the cloud, you necessarily don't need an exchange in country. And the same with your CCP. Your CCP can sit anywhere, is all around the globe. Now you take a common currency that everybody has got access to. I'm not necessarily saying cryptocurrency, but I sort of am, which everybody can use as collateral to trade on these markets and settle these markets anywhere on the planet into the same market, leveraging common pool of stock and collateral for risk management purposes. And then, you've got a bunch of CCP sitting on a ground level, leveraging off of that to make sure that settlement occurs. So definitely possible, but practically, I think it's going to be very difficult. It's going to take some time because the regulators, I think, is going to be the biggest stumbling block in actually implementing that, to be honest, from my opinion.
I think I'd agree with that. Thanks for that.
Thank you,
Daniel, so same question to you. What do you think the big game changers will be?
This might seem somewhat trite, but certainly moving to the cloud is well established. But maybe to Pat's point, we are seeing markets that are still not too electronified. We always think of equities or mature interest rates markets, the futures markets, but applying tech into other areas like cash markets in the U.S., like we're doing a lumber exchange, where there's still, you'd be surprised how much labor and they have these huge brokers. Maybe they're at home now, but they're all on the phone, call around markets. So there's a lot of, seems to me, with what's happening, the technology and is moving that way, and there's a lot to be done there. If that makes sense.
Thanks for backing me up, Daniel.
Yeah. Clive. did you
Unmute,
lose
Clive.
your- you're muted.
Martin, so same to you, really, where, you know, you've got lots of different perspectives here.
Yeah, I mean, I agree with Daniel. Actually, I think there are a number of smaller markets out there that are phone based or paper based at the moment, and there's an opportunity to really get technology and to help those guys out and make those markets a lot more efficient. So certainly opportunities there. I think the other really interesting one is just going to be seeing what's happening with the retail side of trading that's really taken off in the last 12 months, and exactly what infrastructure they need to maintain that. I mentioned earlier portals and access to a lot more closer access to things. That's going to be interesting. And someone mentioned cloud before. I think that's another interesting. I guess it's a bit of it's an infrastructure type question rather than a markets type question. But we're certainly seeing people being a lot more willing and keen to use cloud hosting and servers rather than hosting themselves. The cost benefits can be pretty dramatic. There are performance trade-offs at times, but we're certainly seeing people being quite comfortable going to cloud hosting now, whereas in the past it had to be local and on their own kit.
Yeah, I think I'd agree with that in terms of the trend. And last but not least, Louis-Jean.
Definitely what Martin said. Economies of scale, leveraging your exchange off on the cloud, and like you said, it's an infrastructure question, not so much a solutions question. For us providers, all of us providers, it allows us to actually drop solutions down where people can just basically sign up and start using your exchange platform. But I think the huge benefit of that is you're going to see smaller exchanges coming up because, of course, the CapEx expenditure is so much lower using these technologies. So you're going to see a lot more smaller exchanges popping up. And I think you're going to see the sort of, not the breakdown of the big exchanges, but these smaller exchanges are going to focus on specific products and specific niche markets and going to start controlling these markets. And we're going to have a diversification of more exchanges actually running these markets, making the markets deeper and more resilient, to be honest with you. So, and how's the regulators going to react to that? It's going to be very interesting. And of course, for example, what do you do in a Reddit scenario where somebody says, well, let's start trading GameStop, and you've got an exchange that's basically run by 5 people sitting in the cloud. But it does allow for those opportunities to exist, of course, which is, and of course, smaller exchanges, lower cost base, lower CapEx, lower trading fees, Pat, make it easier for the retail guys and the brokers to actually enter those markets, which can solve Clive's problem of the open interest being stuck.
I mean, the pluralization of access is a real game changer, isn't it? We've run over. Thank you very much. Fantastic panel, Pat, Louis-Jean, Martin, and Daniel. Thank you to the AFM for letting us do this, and hopefully it's been helpful and interesting. I believe it's being recorded, so you'll be able to watch it at your leisure, should you so wish. And Paul, back to you, I think.
Thank you. And I even remembered to unmute, which is a rarity. This event's it's been a good event. I enjoyed it. I hope everyone else did. And I think I'll probably be listening to the recording again. A couple of points that were food for thought there. Oops, my camera went. It's also been an event which is a unique event for those of us that have been to multiple AFMs. If you're still there, Rod, must be the first time we've got through a panel without you making a point or asking a question. Do we take it that even you are in full agreement?
Now, there's good reason for it, because I can't understand what you're talking about. Let me just say, there's nothing better on a Friday afternoon than to look beyond the weekend. And so I really appreciated everything all the wizards said. It was very interesting. Thank you very much.
I was going to be rude and say the one cloud that Rod is familiar with is from his agriculture days, and it's the one that brings rain for the farmers. But
and we're having a great storm at the moment. It's pouring here. But
Well-
one thing that's interesting and more on the product side is if we introduce water, which I do think is going to be a commodity that's going to be traded one day, if not soon, will there need to be any type of technology modification, or will it just slot in as a, excuse the pun, as a liquid product?
any thoughts on anyone from the commodities, systems, trading?
Having been involved with an Australian, peripherally with an Australian water blockchain initiative, I would suspect the product design is going to be down more to access than it is anything else. But I think the technology will enable the market. I don't think it's going to be one of those markets that would stand up on its own without that, because if you're trading water rights, you need to know instantaneously who's got what. And I think we're a long way away from working out the detail of that market. And the biggest fear I have is that you get it wrong and it potentially causes war, and that's not a good thing. So I think I would agree with you. I think some form of trading of water or rights or something like that would be it will be enabled by technology, but we have to get the product design right with the technology, because otherwise it's a dangerous thing.
Okay, so unless there's any other comments, additions, interjections, or pearls of wisdom to supplement the ones we've already had, a lovely message there from Michelle. Thank you. I will say farewell from sunny Sussex in England. And I know Clive's got the same weather as I have today. And for those of you that have got rain, I'm sure it'll pass. All have your jabs when you get round to them. Stay well, stay safe, and see you soon.
See ya.
Thanks, everyone.
Thanks, Clive.
Thank you, everybody.
Thank
Appreciate
you.
it.
Bye-bye.
Yeah.